If we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched. It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go.
No pause, no pivot. The Bank of England also this morning, breaking news, it raised interest rates as well, 75 basis points to a level of 3%. That's the biggest rate hike since 1989. Joining me right now was former IMF chief economist and Harvard University economics professor Kenneth Rogoff. Ken, it's great to see you this morning. Thanks so much for being here.
Good to see you.
What is your reaction to the Fed's move yesterday and what you heard him say?
Well, I thought the core of it made sense. They have to start slowing down because there are long lags in the effects of interest rate hikes. And I also think it made sense to say, look, I'm not promising you a ceiling. Now, I think what he hasn't said, but eventually will say, is not only are we going to keep hiking, but we're going to be very patient about getting to the peak. I think if they really wanted to get inflation down in the 2 to 3% range on a sustained basis, they might need a Fed funds rate 6 or higher. I don't think they're going to go there, but that conversation's yet to come.
Yeah, but, you know, it's not just the rate hikes that we're focused on. I spoke with Thomas Hoenig this week, the former president and CEO of the Kansas City Federal Reserve, who raised the issue of liquidity, these liquidity concerns in the Treasury because of the runoff of the balance sheet, $95 billion a month. We're talking about $1 trillion in liquidity taken out of this market. He says there will be dislocation as a result. Are you expecting markets to be reacting to that?
I think the interest rate hike is much, much more significant than taking the liquidity out. Although, of course, we saw in England there are pockets where it matters. That's what happened after the Russia default in 1998, when we thought the Treasury bill rate, Treasury bills would never have a problem, and they did. So maybe Thomas Hoenig is right. But the interest rate hikes are sure putting a lot of pressure across the board. I want to just comment on one thing Powell said. He was saying, we're going to keep raising rates because we know what to do if we over-tighten. We'll cut. It's funny. It's a mirror image of what they were saying a while ago. Well, we don't want to raise rates because we know what to do if there's inflation, but we don't know what to do when there's a recession.
Unbelievable. We're looking at some serious destruction as a result of higher rates already. The mortgage rates are above 7%, and you're seeing that cool down on housing. But it hasn't really caught up to jobs yet. We're looking ahead to the October jobs report out tomorrow morning. Economists are expecting 200,000 jobs added to the economy, with the unemployment rate rising to 3.6%. Ken, what do you expect in terms of the jobs numbers? And do you think that jobs catch up to the rate hikes at some point?
I certainly do think jobs catch up to the rate hike at some point. But Maria, one of the things which really has everybody confused is that jobs are strong, but growth is not. I mean, productivity is just terrible. And is it that really wages are higher than they seem because of changes in working conditions? Employers are distracted by pressures to take on social issues, or just a global phenomenon. I don't know what it is. But it's a real disconnect between what's going on with growth and what's going on with labor. And I guess it'll play out as we go forward.
Yeah, I mean, so what kind of a macro story are you expecting in 2023 then, Ken? Because, look, we're seeing the impact in housing, and we may very well see it elsewhere as the rate hikes basically create demand destruction in a number of areas.
Well, absolutely. I mean, I think, you really have to look at the world, which is in bad shape. I mean, Europe's in high inflation, recession. China's in their equivalent of a recession, or they might actually be in a negative growth recession. Japan is on the brink of bursting with its fixing the yield and zero interest rate policy. they're likely to go into recession. So it's very hard for the United States to resist that. I mean, I worry that not only we're going to get a mild recession, I think the chances that we get a significant recession are really pretty high.
Yeah, and how do you deal with that? I mean, are you talking about consumerism also taking a hit? We're headed into the holiday seasons, and so far, you know, a lot of the CEOs of the banks have been saying so far the consumer is strong.
No, I think it's a 2023 story.
Yeah.
The interest rate hikes take a long time to really eat at the underlying economy. Yeah, they hit the stocks really quickly, but employment output, I mean, lots of surveys of all the literature suggest 6 to 12 quarters, even more. So I think that all lies ahead.
All right, Ken, great to talk with you. Thanks so much. Kenneth Rogoff joining us this morning.